All right, I can see people are starting to show up. Hello, everybody. Hope you're doing well. We are so disappointed that we couldn't do this in person. We thought that perhaps the tide had turned and that it would be okay, but due to safety issues with your health as our primary concern, we decided to reschedule. So, thank you for your flexibility and patience as we did that. And hopefully in the future we can reconvene in person. But for now, we're going to be virtual this year. So we're going to wait just a few more minutes here as people are showing up, and give people some time. Hope you're all doing well. Yeah.
Yeah. Haven't seen you in a full suit in a while, Brad. You're looking good.
Yeah. Kind of nice to dress up. I was looking forward to doing it in person. The good news is we still have the venue at Morgan Run, so we're thinking about what type of educational activity can we do later this year. Hopefully later this year we can reconvene in person. We're optimistic about that. So, well, as we're waiting here, I do need to. I guess I've got to give a little shout out to our San Diego State basketball team. So as you know, Matt Callahan is a University of New Mexico Lobo, and the San Diego State Aztecs just blew the Lobos out of the water on Monday. He came into work on Tuesday, all sad.
It wasn't even a game, and the odds were that we were supposed to lose by 17, which is bad enough, and they ended up losing by more. So yeah, enjoy the win.
Yeah, yeah. Well, we'll take it while we can get it. San Diego, the State's having a pretty good year, so hopefully they keep it going. All right, we see more people showing up here. We'll give you guys a couple more minutes, and then we'll get going. Ruben, I see that. Yeah, we definitely do owe you drinks and appetizers. That's for sure. Oh, that's right, Todd. Yep. The Aztecs, they did win by 25. Make sure you rub it into Matt. All right. He's a diehard New Mexico fan. Mrs. Adamari. Hi, Becca. How are you? Good to see you. All right. All right. Well, we're going to go ahead and get started and keep this thing running on time. So I'd like to say good evening to everybody. And on behalf of the entire team at Seaside Wealth Management, we want to welcome you to our annual client year in review event. As you know, I'm Brad Lineberger, president of Seaside Wealth Management. And we are joined by Matt Callahan, who's a wonderful advisor and a big part of our team here at Seaside. And if you haven't had a chance to meet him, make sure you do, because you'll really enjoy him. He's a great guy. And before we begin, we've got a couple of housekeeping items that we're going to go over. As most of you know, we're a big believer in educating you, empowering you around your money, helping you create peace around the issue of money. And one of the ways that we do that is with these client events. And another way that we do that is twice a month, we send out a blog post. We want it to be on something topical and something that's educational. Some months it might be around Social Security, others it might be saving money on taxes and retirement, or it might be about investments in the markets. So in any case, if you're not signed up for that, let Stephanie Page know on our team and she can get you signed up. And we've got a couple of other neat announcements for things that we're going to roll out later this year as far as education and empowerment around your finances goes. So tonight, as usual, we're going to go through the material that we've prepared for you. And then we've got questions. We have time for questions and answers at the end. So hold your questions to the end. And if we don't cover it during the presentation, we'll get to it at the end. So with that, we'll begin. And so 2021, we're gonna look back here, and I want you to remember where we started 2021. It really was a year of uncertainty, and there was so much going on and so much that we weren't sure how it was going to transpire. A new president was coming on board. We didn't know if the recovery that had started in 2020 was for real. So we just didn't know if it would continue into 2021.
Yeah, Brad, great point. I mean, who would have thought that after the fastest decline into bear market territory, followed by the fastest recovery in history, would wind up ending 2020 up 18.4%. A lot of us thought that we couldn't go any higher for 2021, but let's take a stroll through memory lane.
And I think it begins and ends with COVID.
Yeah, you're right. I mean, 2020 was all about COVID, and we started off 2021 the same way. COVID was the topic. I personally thought that we would have been out of it by now, but clearly I was wrong, and the world still remained gripped in the throes of the pandemic.
Yeah, I mean, we're 2 years into this thing, and we're still not out of it, but hopefully we're going to turn that corner. I think this graphic is perfectly depicts kind of where we were at last year, and to some degrees where people are at this year. But last year, all the uncertainty, new president with new policies, tax changes were coming, a spending plan was coming, inflation reared its ugly head. We had the Delta variant, then we had Omicron, interest rates were low, which was fueling a boom in the housing market. The potential end of some of our favorite strategies like the backdoor Roth IRA strategy, or even Roth conversions altogether. In other words, there was a lot going on. So what was a prudent investor to do with all this uncertainty?
Great question. So you would think that in a year full of uncertainty that bonds would, thrive during an environment like this, and that stocks would be extra volatile. But what we found out was that it was just the opposite. 2021 was the second worst start of the year for bonds. And what's interesting about 2021 is that in all of the other years where bonds started off poorly, they finished the year strongly. But 2021 was an exception. The bond market index ended up finishing the year down 1.54% for the year. And ironically, in a full year of uncertainty, the stock market actually did really well.
Yeah, definitely caught some people off guard. So with the market doing well, sadly, so many investors were still parked in cash on the sidelines and did not participate in how well the markets did. Let's take a look. So in 2020, we had 4.8 trillion with a T dollars in cash parked on the sideline. And so that was a record amount of cash. We've never seen that much cash on the sideline. And it's because people were spooked from what had happened back in March. They didn't think that the recovery was real. That started in April of 2020. And so we'd have to go back in time. There's only been a couple of other inflection points in time where that much money was parked in cash. And one of the times was January of 2009. Just immediately following the Great Recession of 2008, right? And we all know what happened. The market went on one of the most incredible runs we've ever seen. January of 2009 was the worst time to be parked in cash. You missed out on the entire run. And then we'd have to take you back to January of 2003, immediately following the tech wreck. After the dot-com bubble started to burst from 2000 to 2002, investors were spooked and they were parked in cash. And so the good news for everyone on this webinar tonight is that typically having a lot of money in cash is really a contrarian indicator. That's a really positive sign for the stock market. So in the other times where we've seen this much amount in cash, the average annual return for the stock market 3 years later was 16.4% per year and 19.2% per year, respectively. In other words, when Main Street Americans are spooked and they go all to cash, usually the stock market tends to do really well. The good thing is, Matt and I are really passionate about making sure that we're in some essences, your behavioral coaches, and making sure that you do the right things at the right time and not the wrong things at the wrong time. So we would never let you go all to cash. And that's really a big part of our job. We're your insurance policies. You've got insurance on your house, your car, your boat, if you have one. We're your insurance policy on your finances. So We're never going to let this happen to you, but it's kind of sad.
And I mean, just to keep in mind, just like we saw in the bond market, we know that past returns are not indicative of future results. So as we saw in the bond market, the history didn't follow the same pattern. So we don't know exactly what will happen in the future, but this is why that we protect you with a globally diversified portfolio. So this allows us to eliminate the guessing game of what's going to be the next best thing.
Yeah. Yeah. Good point. And so since 1950, we've had about 10 bear markets. So a bear market is when the stock market goes down by 20% or more. And so if you take an average of all 10 bear markets since 1950, the average annual decline is over 35% per year. The good news, though, is that on average for those 10 bear markets, 1 year following the bear, the market's up almost 46%. And then 3 years following the bear market, the market has averaged 16% per year.
Yeah, and while it may not feel good going through these bear markets, hopefully we coached you well enough to know that most of you are young enough that you'll probably experience another 6, maybe even 8 of these in your lifetime. They'll be called different things. It'll be brand new and never has happened before, but we actually like volatility because of what the historical returns looked like 1 year and 3 years after events like this happen.
Yeah, in fact, Matt actually wrote a really good blog post on it called Volatility is Your Friend. And if you haven't had a chance to read Volatility is Your Friend, go to our website and you can see it. I know it sounds counterintuitive, but it was a really interesting piece. So how did global markets do last year? And I'll give you a quick rundown of what happened. So the US stock market was up almost 26% on the year. So it was another terrific year for the US market. International developed markets were up almost 13%, and that's a good sign. Hadn't seen the international investments perform that well in a while, so it was good to see them switching back on. Emerging markets were down about 2.5%. And real estate, who would have thought that global real estate would have been the big winner coming out of the pandemic of 2020? Everybody's working from home, basically work from anywhere. People thought the real estate market would go in the tank, and it was the leading asset class last year. Meanwhile, bonds were actually in negative territory. They did not return well, but a globally diversified mix of all these asset classes did just fine.
Yeah, and if we look at the bottom of this chart here, you can see if you stayed invested from 2001 until now, most of these asset classes were up nearly double digits, 10.2, 7%, and 12.9. And then in the bond market, healthy 4% there. So just keeping the long-term perspective, the markets in the short term, very, very unpredictable, but in the long term, very, very predictable and reliable. So just keep that long-term mindset, even if it's not fun along the way.
Yeah, no doubt, no doubt. And, hindsight's 2020. And I think if we're honest with ourselves and we really think about the last 3 years, how good last year and then the 2 years before, I think if we're really honest, we would admit that no one really expected the returns that we've had over the last 3 years to be what they were. And this goes to point out that oftentimes the market catches us off guard, catches you by surprise. So, in 2018, we had a 3-month bear market where it was down darn near 20% in 3 months. And so heading into 2019, no one thought that'd be a good year, and it was phenomenal. And then heading into 2020, there was the election. And then, of course, COVID happened. No one thought the market would end in positive territory after a fierce decline. And sure enough, it did. And then heading into 2021, no one thought it was going to go up, and it did. And so the point is, oftentimes the market surprises you. And just when you think you've got it figured out, you don't. And so it's why it's so important to maintain the global diversification and manage through markets, not try to time them or anything like that. So on that note, who would have thought last year that the number one performing country would have been the Czech Republic, up over 50% on the year? I bet if I were to take a straw poll of the participants on this webinar, nobody would have said, oh yeah, for sure, Czech Republic, that's going to be the big winner last year. and then if I said, okay, what about over the last 20 years, that the number one performing country over the last 20 years would be Denmark, of all places. So, kind of a surprise. And again, it's why you can't, it's impossible to pick on a forward-looking basis the best country, the best region, the best stock for that matter, the best asset class. It's why it's important to own it all. But so interesting that our Danish friends has been the number one performer over 20 years. And so continuing that theme, you take a look in 2020, and what drove the positive performance of 2020 was these big five names. And you heard us talk about that at the time, but the big five: Microsoft, Amazon, Facebook, Google, Apple. And so these five countries really, so the index was in positive territory for the year, but it was due in large part to the performance of just five companies. Those five companies were up a combined 49%. Meanwhile, the other 495 companies were down 3%. So while the index had a positive 10% returns, it was really driven by just five companies. And so clearly, it was not a sustainable rally in 2020. And the big question heading into 2021 was, would the rally have legs and continue? Everybody was wondering.
Yeah, and Brad, what we saw is that it actually did, but in a much more healthy way, healthier than 2020. The overall performance came from a much broader space of the index. If we look at the smaller 400 companies by market cap, they outperform the larger companies by a pretty large margin. Five names this time are only generating about 3.8%. Unlike 2020 when they were generating about 49%. So again, highlighting the importance of why maintaining a disciplined diversification and not chasing that next hot stock.
Yeah.
And then so with that, with healthy things, let's pivot and take a look at our talk about inflation.
I love this one. So inflation, we all feel it every time you go to the pump. You're having to pay an arm and a leg at the pump. I absolutely love this. So just cheeky humor for a dry subject, but definitely. So inflation in technical terms is really the decrease of your purchasing power. And so we put this together to illustrate that. Let's say this year, 2022, you're spending $5,000 a month. And let's say inflation is running at 3%. In 10 years, you're really going to need to spend $6,720 to be able to give you the same purchasing power that $5,000 gives you today. And in 20 years, you're really going to need to spend over $9,000 to be able to purchase what $5,000 buys you today. And in 30 years, you need $12,135 to give you the same purchasing power as $5,000 today. And why we pick 30 years is that most everybody on this webinar has a good 30 years ahead of them. So you have a 50% probability of living into your mid-90s. So there's a good chance that a 65-year-old today is going to make it 30 years into the future. Mm-hmm. And so let me put it to you another way, and this can be kind of shocking. If you don't properly prepare to fight inflation and defend against it, let me show you the decrease in your purchasing power that can happen. So $5,000 today, if not properly prepared for and fighting inflation, that purchasing power will decline to $3,720 in just 10 years. 20 years from now, $5,000 only buys $2,769 worth of goods and services. And 30 years from now, $5,000 only buys $2,060 worth of goods and services. So if you want to maintain your lifestyle that you enjoy, you really need to adequately fight off inflation.
Well, the good thing about it too, Brad, is that we are accounting for inflation in everyone's financial plan. So this is something all of you on the webinar don't need to worry about. We are keeping an eye on this. Yeah. But what I wanted to show on this slide, what we're looking at, it's a real world example. We are seeing the cost to go to a movie in these different years. So for example, in 1950, if you wanted to see Cinderella, it cost 46 cents to go to the movie theater. If we were going to the movie theater in 1980 to see Empire Strikes Back, it cost $2.69. And then in 2010, Toy Story 3 $7.89. And then in 2020, to see Avengers Endgame, $9.16.
Although Stephanie swears it cost more like $39, but that could have been the 2 glasses of wine that she had
that'll do it. That will definitely do it
at the nice theater. So no, just kidding, Steph, if you're out there. Yeah, but this really illustrates the point that it is getting more expensive to do and enjoy the things that you like to do. Mm-hmm. So what's also so interesting about 2021 versus 2020 is such a sharp change that we saw in several things that everybody purchases. One being, if you travel, if you fly, airfare was down 27% in 2020 because nobody was flying. And then we saw a sharp snapback in the cost of flying, up nearly 25% last year. Gasoline, I think we can all attest. So 2020 was good as far as gas prices go, down 23.4%, and then have shot back and really skyrocketed up 45% in 2021. And then used cars and trucks. I hope you don't need to go get a used vehicle these days because they're hard to come by and they have gotten really expensive. So they dropped in price in 2020. Nobody was driving. And then they've gotten much more expensive to date. When it comes to inflation, it's not equivalent across the board. And so our November reading, so really over the last 12 months, inflation is running somewhere between 5 and 6%, depending on which report you look at. But what's so interesting is it's not 5%, 6% across everything you buy. Take a look at this. So meats, fish, poultry, and eggs up 8%. Car and truck rental, holy cow, up 52.6% year over year. Women's dresses up 11.9%. Who would have thought with everybody working from home that women's dresses would be up nearly 12%, but they are. And then the sporting goods up 7.8%. And we definitely feel that cost effect in my household with everybody playing sports. And of course, stationery and gift wrap up nearly 10%. So you can see inflation is not affecting everything equally, nor is it affecting everything geographically the same as well. So let's take a look at inflation in San Diego, where a majority of us live, up 6.5%. So things have gotten much more expensive here at home. I guess the only good news is we don't live in Atlanta, where inflation is running at 7.9%, or St. Louis, where it's running at 7.5%. So we get better weather and it's a little bit less expensive than a couple places in the country. But you can see that the impact of inflation is really being felt by the majority of the country, just in different ways. The other interesting thing to note is that inflation, as it's calculated, so when it comes to real estate, the way that real estate is calculated in the CPI, which is the Consumer Price Index. So home ownership, the cost to own a home skyrocketed in 2021, up 18.6%. And while rents did increase, the rental increases did not keep up with the increases to buy. And so, you fast forward to, so inflation is running officially, according to CPI data, at 6.8%. However, many of you out there say, gosh, the cost of everything I'm buying it feels like it's running higher than that. And if that's how you're feeling tonight, you're not alone, and you're actually right, because the way that we calculate the consumer price index or inflation today has changed over the years. So if we were using the calculations if we were calculating it the way we did back in 1990, inflation, the official inflation number would actually be 10% over the last 12 months. And if we were using the calculation the same way that we were using it in 1980, then inflation would really feel more like 15%. So if you're out there going, okay, yeah, the cost of everything I'm buying is going up, and it feels like it's more than 6%. You're right, because the reality is it is. And to Matt's point earlier, we have absolutely accounted for this in your financial plan. So rest assured, you're going to be okay. But it's definitely, it's worthy of paying attention to.
Mm-hmm. Yeah, so inflation is high, but interest rates are low. And this is the widest gap that we've seen between inflation and interest rates since 1980. And so if inflation gets worse, the Fed has to raise rates in order to stick to their target goal of 2% inflation. And I want to pause there and just reiterate that the Fed is very clear that they want to have inflation be at 2% for the long term. And so 1980 was the last time that we saw inflation at a meaningful number. And you can see what happened to interest rates the last time that inflation was high. They went to the sky high. And so, in fact, if most of you here probably remember buying a home and it had 16% interest. And so I just want you to keep in mind that if you are thinking about buying a home in the near future, just be aware that interest rates are probably going up.
Yeah, no doubt.
And so how does the stock market perform when interest rates go up? People are asking us a lot of good questions. Should we hedge against inflation using gold? Should we use Bitcoin, maybe commodities? But what we found in all the research has proven over time is that stocks have actually been the best hedge against inflation over long periods of time. So if you think interest rates are going up, and that's what we think, the good news is that stocks perform well in a rising rate environment.
Yeah, no doubt. No doubt. What about Bitcoin, Matt?
Great question. And I just wanted to spend less than a minute on this. People are asking us, should we buy Bitcoin? And I know a lot of you probably have friends that are making a killing on Bitcoin, but
or kids.
Yeah, this is true. But Bitcoin, it's hard to put a value on it. And what I mean by that is that it doesn't produce anything. So think about the great companies that you're investing in your portfolio. You can see the goods or services that they're producing. So it's easy to put a value on that. And then also Bitcoin is just very speculative. I mean, the volatility is just unreal. And if you don't have to take the unnecessary risk, we would just say, stay clear of Bitcoin. We are keeping an eye on it. If maybe in the future it doesn't make sense to add, but as of right now, we would recommend, or for us, we're not putting it in our portfolios, and we would recommend that you don't do any Bitcoin on the side either.
So I'm glad you brought up Bitcoin. And I think really a lot of what may be going on there is just FOMO, the fear of missing out. And it's tough. You hear your neighbors doing it, your friends doing it, your kids, your grandkids, and everybody, they only tell you how much money they're making. They never tell you how much money they've just lost. And so for today, it just reminds me of a lot of some of these other fads that we had. Now, is it here to stay? It might be, and we're paying very, very careful attention to it. And if we ever feel like there is an opportunity to introduce it to the portfolio in a way that's meaningful and makes sense and is prudent and safe, we will do that. But as Matt said today, we're steering clear of it. So the other question comes up, we've had 3 really good years in the stock market, last 3 years. And people are saying, well, what's going to happen? What could possibly happen in this 4th year after 3 really good years? And the truth is, no one knows for sure. But what's interesting is that the last few times this has happened, so we would have to go back to the 40s, a couple times in the 40s, the late 40s and early 50s, and then of course the 90s. After we've had 3 really good years in the market, we had a 4th year that followed it. So will we have a 4th year that's as strong as what we just experienced? Only history, with history as our guide, we might. We don't know for sure. But I just thought that was interesting that the other times where we've had really strong 3-year performance like this, the 4th year turned out to be pretty good.
Yeah, and just so you all know that if your time horizon is long enough, you can remain invested and not worry about having negative returns. In fact, 100% of all 16-year rolling periods have had a positive rate of return in the United States. And so if you're thinking to yourself, I don't have 16 years. You might be badly mistaken, because for a 65-year-old, there's a chance that you may not only have one of these, you may even have 2 16 periods left in your lifetime.
Yeah, I know. And it's funny too, because when we share this with people in our reviews, there's 2 distinct groups. There's some people that are high-fiving us and hugging us saying, oh, 95, 100, you mean I'm going to live that long? And then there's the other group that's kind of like Eeyore from Winnie the Pooh. wah. I don't want to live that long. So I don't know where you're at tonight, but let me just remind you that Matt and I, neither of us control this. So only it's not up to us. But we do study this and we want to pay careful attention. And I think the good news, though, you might be sitting there going, okay, guys, I get it. Stocks for the long haul over 16 years, we're going to have positive. There's never been a 16-year period with a negative result. But let me just reassure you that bonds, the whole purpose of having bonds in your portfolio is to be the buffer of the portfolio. So we know that stocks tend to do really well over long periods of time, but they can go through 3, sometimes 4 or 5 years where they're not so good. And that's where the bonds come in. And that's why you have bonds in your portfolio. And sadly, you do pay a price for having those bonds because there's years like last year where they don't do that well. But it's nice to know that even in a bad year for bonds, we're talking low single digit, down 1.3%. So it didn't wipe you out. But it's good to know that the role of bonds is to be the shock absorber in the portfolio.
Yeah, and with the bond portion of your portfolio, that number, instead of 16 like we saw in stocks, it's actually, there's never been a 4-year period that we've seen negative returns in the bond market. So if you're thinking that you may need to access capital from your portfolio to help fund retirement during down market years, we have the bond part of the portfolio to be able to tap into to continue helping fund your lifestyle.
And what's so interesting about that is typically when bonds are doing poorly, the stocks are actually doing well. And oftentimes the better the stocks are doing, the worse the bonds are doing. And last year was a prime example. Stocks did outstanding, bonds lost money, but on the whole, everybody had a really, really good year. And then when stocks do terribly, that's often when bonds shine. So they do kind of move opposite of one another. Now, the one thing we do want to prepare you for is volatility. And really last year, 2021, did not have a lot of volatility. And we'd have to go back to really March of 2020. There was some big moves in March, but then after we got through the worst of it, the market just went on an upward tear the back half of 2020. And I want to caution you because when you look at the last 10 years, you look at volatility, the number of days with big moves being up or down 2%. The last 10 years, we really haven't had a lot of volatility in the last decade. And so heading into, we've been preparing this for over a month now. And, I really wanted to caution you as your coach, get ready to strap on your seatbelt, put your helmet on, get ready for the volatility. And then January happened. So January did it for me. I don't have to caution you. We just went through it. And now it's kind of like getting punched in the face. Or cold water, doused with cold water. And so my job tonight was to say, be ready. And then January happened and it happened. So that's to be expected. And in fact, on average, going back to 1980, you should just expect the market to be down 14% per year. Because that's what it does. That's how it operates. That's actually really normal.
And that's how you all get compensated, is by you take the volatility on, and you have people that are not working with us. They may be making poor decisions. You guys are being compensated for handling that volatility and managing through markets rather than trying to time the markets.
Yeah, absolutely. Absolutely. So now, with that in mind, the question is, well, should we try and cherry pick some stocks or hand pick some stocks or just pick the big winners? We know tech has had a glorious run over the last 10 years. And so, should we just put everything in our tech stocks, big US companies? We want to point out the fallacy of doing that. And so this is one study of hundreds that are out there. This is a period of time from 1994 to 2020, so 26 years, where the US stock market, if you owned all the stocks in the market, your performance would have been 8.2% per year, which is more than enough to bring all of your financial plans to life. In other words, you would have had outstanding success if you simply owned all of the stocks in the market. And yet people still try and cherry pick and hand pick the big winners. And look at what happened. If you guessed in a 26-year period, if you guessed and you mistimed or misguessed who the top 10% of performers would be, your returns were cut more than in half. And if you guessed and you guessed wrong and you excluded the top 25% of performers, your performance was actually negative over a 26-year period. So the consequences are high, the risks are great. Trying to pick individual stocks, individual winners is a really dangerous game. And it's why we recommend against it. Good news is the way that we have you invested is we're going to prevent you from blowing up your portfolio. And you'll see that in a minute, but you're never going to hit home runs, and you're also never going to strike out. You're going to be steady.
Yeah, I was about to say, Brad, people are probably wondering, well, what can we do if we can't pick the stocks? And so that's what this slide is here. And some of you have seen it, but I updated the numbers here. And basically, if you're going and things are being successful for you, you aren't going to like us along the way. And let me tell you what I mean by that is this slide is showing the S&P 500 versus a diversified, globally diversified portfolio. And we're using 60% stocks, 40% bonds. And so from 2000 to 2002, the S&P 500 was down 40.1%. The globally diversified portfolio was down 15.7. And so on the far right, you'll see this is what you're feeling. I lost money. Brad, Matt, you lost me money. And then so let's look at 2003 to 2007. The S&P, the market was up 82.9%. Your portfolio was up 87.1. So we did good this time. Diversification worked. We did better than the market. But 2008 happens, market's down 37%. Your portfolio would have been down 26.6. Again, Brad, Matt, you guys are doing this wrong. I lost money. And so from 2009 to 2019, the S&P just went on a tear. It was up 351% over this time frame. Your portfolio was only up, I say only, but up 220.1%. You're thinking, well, I didn't make as much money. Get to work, guys. Come on. And then in 2020, I'm sure we all remember it, there was one point that the market was down 30.4%. Your portfolio was down during this time 23.1%. Again, I lost money. And then so 2020 to 2021, the S&P was up 119%. And this one, you're probably really mad at us, only up 66.6%. I didn't make as much money. But if we look at from 2000 to 2021, if you invested $100,000 and just stayed disciplined and we managed through the markets, you would have made $474,970 versus the S&P that made $474,550. So we took less risk and got better returns over that time frame. So diversification can work, even though it may not feel good along the way.
Yeah, and where it's so important, especially when it comes to retirement income planning and taking distributions, is your sequence of returns. And you'll notice that the S&P 500 has much larger downdrafts, much larger declines than a globally diversified portfolio. And if you're in retirement and you're pulling money out of your portfolio and it's suffering a big decline, you're going to spend it down faster. In fact, anybody that retired in 2000, taking somewhere around 5% of their portfolio per year out, if you had put it all in the S&P 500, guess what? You went back to work in 2016. So 16 years into retirement, you ran out of money. That's exactly why we want to make sure that we remain globally diversified. Not always fun, but as Matt points out, it's definitely effective. So, as we start to close, just people always ask, all right, guys, come on, global diversification, we get it, can't time the market, but come on, you got to have some, what are your predictions? What are your predictions? And so,
I told him to find his crystal ball.
But it broke. My crystal ball broke years ago, but we're going to have a little bit of fun with this. And we're going to show you why oftentimes the predictions that you hear out there are not always to be followed. And so Nuveen, which is a world-class money management firm, here's their prediction for 2021. This is their prediction for 2021 on the US dollar. Nuveen said that the US dollar would sink to a 5-year low last year. Here's the reality. The dollar finished 2021 higher than every other currency except the Canadian dollar. And so the US dollar got really, really strong last year, which is great for travelers, but not always great for international investors. How about Bank of America's prediction? So their forecast was that in the US, this is going to be kind of a transition year last year. People are going to be going from services back to goods. They're going to be thinking about going back in person from virtual. The scars from COVID will remain, and the economy is going to grow maybe 4.5%. But don't worry about interest rates going up because the economy is not going to be hot enough for that to happen. The reality is strong economic growth and rising prices. The Fed announced in December it's going to begin the work of combating inflation. So they're going to start with tapering their bond buying program. And then they've made it very clear there's going to be interest rate hikes this year, not 2024, but this year, 2022. So Bank of America got it dead wrong. Wells Fargo, with their prediction on where the stock market would end up in 2021, they said S&P 500, 3,900 at the end of last year, representing a 6% upside on the year. Reality, S&P 500 closed out the year at 4,766, up 22% higher than predicted. How about Jeffrey Gundlach, the bond guru? This guy's the expert, really well-respected thinker. His forecast was that Latin American markets would be the place to invest last year. Latin America is coming back as a result of the vaccine. It's one of the primary beneficiaries of the vaccine. He said to invest in Latin America if you have the risk tolerance. Reality, Latin America was extremely volatile, up 8% some months and down as much as 10% in a month for an overall decline of 8%. I'm glad we didn't listen to Gundlach and go all in on Latin America. How about China from our friends over there at T. Rowe Price? Well-respected outfit. Their forecast, they're positive on the fundamentals for Chinese equities in 2021 when a more consumer-led recovery is expected to take hold. Reality, so glad we didn't invest in China all in, down almost 28% on the year. T. Rowe Price got it dead wrong. So in closing, you get the point that we're making, that you cannot predict it, you can't time it. It's always interesting to look back on these things, but now, speaking of looking back, let's see where all of the asset classes in your portfolio have been. And I think this is a really interesting thing to look at. So 2021, we had real estate as the number one performer, up almost 46%, which is so interesting because everybody's working from home, right? How could real estate be the number one performer? And this is publicly traded real estate, but sure enough, it was. Followed by the big US companies, up about 29% on the year. We had value companies having a really nice resurgence, up 25%. Small cap, up a little less than 15. They actually led the rally in 2020. They were the number one performer last year, as you can see, which is pretty typical early on in a recovery. And then they followed it up with really strong double-digit performance. Let's take a look at the bottom half of this chart. We did see emerging markets post positive numbers, but really what I want to focus on is cash paying nothing, 0.05%. I'm sorry for all you savers out there. Bonds actually lost money, as we talked about earlier. And so I want to talk about the global diversification that we're referencing. I want to call your attention to the white box. And the white box is a mix of roughly 60% stocks, 40% bonds, and a very, very moderate allocation. Some people may need to be invested more aggressively, some people more conservatively. Everybody we work with has a custom portfolio that's tailored to their financial plan and their goals and values. But I wanted to use this as a proxy. And so here, the white box up 12% on the year, more than double what a retiree would need to get to make their plan come to life. And I want to take you all the way back to 2010 at the beginning of the decade. Follow along with the white box. It's never at the top. It's never at the bottom. It's always somewhere in the middle. You're not hitting home runs. You're not striking out. And here we are in the far right column. The 10-year performance on a 60-40 portfolio, 9% per year, almost double what you need to make your financial plan come to life. And the beauty of it is your highs are not too high because your lows are not too low. You stay steady, you stay in the middle. This process really works. And what happens is each year we take a look at the top performing asset class or asset classes. And we're wanting to trim or sell out of the things that are high to be able to buy into the things that are low. And it doesn't always feel good because sometimes you're doing what you think is the exact opposite that has been successful lately. But as Warren Buffett says, and we all know to be true, you want to buy low and sell high. And that's the kind of discipline that you have to maintain. So as we start to wrap, I want to call your attention to a couple of really key initiatives for the year. We as your financial advisors, it's so important to have a financial plan, and that plan needs to be driven by your goals, and those goals need to be driven by your values, and your investments need to be a reflection of your plan, which ultimately is a reflection of your goals and values. The investments need to be managed and cared for properly. But we realize that as your financial planners, our job is about so much more than just the dollars. And in a lot of ways, Matt and I view our role as to be a financial life planner, meaning, you may have all the money in the world, but if you're not living life the way that you want to, or you don't have the health to enjoy it, what's the point? Mm-hmm. And so last year we invited out, we really started to roll out the health and wellness series. And this is coming on the backs of COVID. And we realized that without health, we don't have anything. And so we had a wonderful speaker, Allison Meager, come out, a nutritionist, to talk about how to make your golden years really high quality years by eating properly. And this is going to be something that we look to do more of in the future, to really help you have a high quality of a lifestyle and life experience, not just financially, but in all aspects of your life. The other thing we're excited to announce is our Women and Wealth initiative. And there's a transition underway in this country where women are beginning to control massive amounts of wealth. And sadly, it's because many of the guys are dying off first, and women are being put into a position where they have to be empowered and educated around their finances. And so we want to definitely play into that trend. And you're going to notice that about every 3 weeks, we're going to be sending out videos that are educational in nature called Women in Wealth. And they're the kinds of questions that maybe many of you have, but you may be too shy or even embarrassed to ask. You may feel like they're simple, basic questions, but we feel it's really important to educate you around all aspects of your financial life and well-being. So if you want to get a kind of a brush up on some financial concepts, these are small, easy to digest, easy to consume videos that will really help you to sharpen your financial acumen in the future. And then lastly, we want to invite you to come wind down the tax season with us with wine. And so, a big part of our role here as your financial planners is we like to do forward-looking tax planning. And in order to do that, we need your tax return. So we're going to have a wind down the tax season party. It's going to be somewhere after April 15th, but you come in, bring in your tax return, we'll scan it. And that way we can do our work on your behalf and then collaborate with your CPA looking for ways to save money on taxes. But bring us that tax return, and in trade, we'll give you a glass of wine or two and just enjoy it with you. So be on the lookout for that announcement coming shortly.
You can upload the tax return to your Seaside vault as well, if that's easier.
Yeah. So whatever you prefer. Okay. And so at this point in time, we want to open it up to questions, and I'm seeing a couple come in here. Let's see. All right, all right. First question is, all right, you guys mentioned that the markets were going to be more volatile than we've seen in a long while. Should we be making changes to our portfolios because of the volatility?
I'll take that one, Brad. Okay. That's a great question. Our recommendation would be to not make any changes to your portfolio if your goals and your values haven't changed. Just like Brad mentioned earlier, those are really the things that dictate how your portfolio is constructed. And if we were to make changes for what we think is going to happen in the market. That is market timing. And I think we pounded it to the floor that market timing does not work. It's what we want to do is manage through markets. And what I mean by that is rebalancing the portfolio, selling the things that are up and then buying the things that are down. Again, to reiterate, buying low, selling high. And if something did change in your life, maybe transitioning into a new stage, that would be a reason to maybe make a change. But let's talk about that for your specific needs. But if it's just because we're scared of what could happen, we would recommend not making changes to your portfolio.
Yeah. Another one came in, Matt. Since the markets are down, if we have cash on the sidelines, should we invest the cash?
Absolutely. The markets are down. So again, you could be buying more shares now. And if you have a long enough time horizon, we would say, yes, put in the dollars that are in excess of your emergency fund to work for you. But the funny thing is, Brad, I'm curious to hear your thoughts. My answer would be, even if the market was at an all-time high, I would still be saying, yes, if your time horizon is long enough and your goals and values dictate that you should be putting excess dollars into the market, I would still say, absolutely, let's put those dollars to work. And the reason being is because the odds are in your favor. If you have a 5-year time horizon, there's an 80% chance that you will have more money in 5 years than what you started with, even if the market's at an all-time high.
Matt, someone's asking about a chunk of money that they want to access in a year. So you just said 5-year time horizon. This person sounds they've got a 1-year time horizon.
Yeah, with a 1-year time horizon, unfortunately, I would say don't put it in the market. What we would hate is, like we said earlier, is that the market is very volatile or schizophrenic, if you will, in the short term. And if you need access to those dollars in a year, we would hate for them to be down when you need them most. So even though we're not getting any interest in the bank, that's probably the best bet, is to keep it on the sidelines.
Yeah. Yeah. Okay. Here's a good one. Someone's, we have a question coming in around fees and our fees. And, we're very transparent. We welcome, ask us any question. We don't shy away from anything. And so the question was, are fees taken into consideration when it comes to planning and returns and processes? And the answer is absolutely. And we believe that costs do matter. And so returns, when you looked at the returns on that 60/40 portfolio from last year, up over 12%, we're looking at financial plans needing 5.5%. Those returns were net of fee. And every year we do a study, and there's Schwab and TD Ameritrade have all the data around this. We always want to make sure, what's the saying, Matt? You don't want the most expensive. How does it go? You don't want the most expensive, but
we are not the most expensive, and you do not want the cheapest.
You do not want the cheapest. Exactly. And so we've really positioned our pricing to be what we feel is really a little bit less than the average fee, which is most everybody's less than 1.
Brad, I think we lost your.
How's that?
There we go. Okay.
Any better? Okay. Yeah. So we feel that our fees are very, very competitive relative to what else is out there. So we welcome those kinds of questions.
Brad, I have a question for you. It came in. It says, you said that used car prices are incredibly high. Does this mean that purchasing a new car is better and the way to go?
I happen to know the person asking this question is hot to trot to buy a new car. So I guess the answer is, if it's a good deal, if it's a good, we like value investing over here. So if you feel like you're getting a good value and you're not overpaying, and if it works in your financial plan, which for this person it does, I think you could pull the trigger. Matt, here's one around Roth conversions. Are Roth conversions around for 2022?
Oh, perfect. Yeah. So that was one of the things that was on the chopping block this last go around. And fortunately, Roth conversions are still around for 2022. And so this is something that we look at every year to see if it makes sense within your financial plan to do Roth conversions.
Yeah. Yeah. And there's another one that's still left, that's still available. The mega backdoor Roth conversions. So anyone that's working, make sure, go ahead and check to see if you have an after-tax component to your 401k. If you do, it's a wonderful opportunity to get a bunch of money into Roth IRAs through
the mega backdoor, as they call it. So with most of you, we've been adding this into your financial plan and doing it. But if this is new to you, pay attention to what's in your 401k.
One more for you, Brad. How many months of an emergency fund should you have?
Oh, great question. Okay. So we like to have 3 to 6 months. So whatever your expenses are. So think of it that, okay, if I lost my job or if somehow my income stream was disrupted, how much money should I have in cash on the sidelines? We would say 3 to 6 months of living expenses in cash. And the challenge is cash is paying you nothing. The banks are paying nothing on your money. So it's hard to watch your money not grow, but at the same time, it's really nice to have that cushion. Now, for retirees who are dependent on portfolio distributions, if you wanted to be really conservative, you could look at having a year's worth of expenses on the sidelines, because if we had another major decline like a 2008 or 2000 through 2002, having a year's worth of living expenses would allow you to dip into your cash so you didn't have to sell stocks while they're down. But that's why we have bonds in the portfolio, to also help you buffer that sort of thing. So I think 3 to 6 months is fairly standard, 12 on the high side. And it's really hard to have any more than that with how low interest rates are, sadly.
Mm-hmm. Do you have any advice on buying or renting solar for your house?
I think number one, it's good to keep the bill down. So that helps from a cash flow and cash management standpoint. But also pay attention to the credit that you can get. And I know it's been decreasing slightly over the years. But so it's good for the environment, and then also from a tax perspective, it can help. So it also comes down to how long do you plan on staying in the home. So that's one of those things that if we want to crunch the number, if it's kind of a one-on-one thing, we can crunch the numbers individually and get a good answer.
You mentioned that we need to consider how to fight off inflation. How do I do this as an individual?
Well, making sure that your investments are allocated appropriately. So you don't want to be too conservative. You can't have too much money in cash or bonds. You definitely need to get growth. And then you want to be really mindful of your spending habits. And if this is the kind of thing that's keeping you up at night, Matt and I have the ability, we can run advanced scenarios, advanced plans in your financial plan to, if you're really concerned about inflation, we can run a scenario where we show it at 5 or 6.
And I would piggyback on that, Brad, that just like we saw earlier, the Fed is really adamant about wanting to hover around 2%. So yes, we can do it, but I would hope that with the Fed, targeting that 2%, we're projecting higher than that in our plan, so we're being conservative already. I would lean towards 5%, maybe a bit too aggressive and unrealistic.
Right. That's such a good point. I mean, historically, I think what happened is the Fed kept interest rates too low for too long. And everybody got used to drinking punch at the punch bowl, and we want our interest rates really low. The reality is the Fed's very committed to that 2% target, which ultimately means now is they're playing catch up here, and they're going to be raising rates. I think rates are going to go higher than what many people are anticipating. So that could potentially affect your real estate purchases if you're using leverage to make real estate investments in the future. So, Matt, you mentioned it earlier, but if anybody has any debt that they need to refinance, or you're thinking about purchasing anything with debt, we may look back in time at where rates are at today and go, wow, it was at a generational low.
Yeah. Looks like we have one more, Brad. It says, do you recommend investing in emerging technologies? If so, could one do so, and to what extent?
Yeah, and as we showed earlier today, we want to be really careful to avoid trying the timing and selection game of individual securities. So we prefer to do it through our small cap positions, both in the US and as well as international abroad. So small companies have a lot of the emerging technologies in them. So it's a much more secure way to do this. Historically, over the last 80 years, small companies, in particular, emerging technology companies, have done better than others over time but it comes with more volatility. So for that reason, you better have the stomach for that volatility. And that's why those positions in the portfolio don't represent an outsized share, just because we again, you saw that chart where we want to keep the ride as smooth as possible. We do need the growth to keep up with inflation, but we want to keep it smooth. So your small cap position in both US and international.
Yeah, and then looks like one more correlation between interest rate hikes and the stock market performance. Historically speaking, we typically see good stock market returns when interest rates are going up.
Somebody said something funny about which one of my kids walked into the room and behind the desk in a white tee. I don't know, but I'm going to go find out who it was.
What is your recommendation on acquiring real estate at this time?
That's a great question. So real estate is a wonderful asset class, and it has a lot of benefits and a lot of merits. And it's part of a globally diversified portfolio that we're running here. Many of our clients have also had a lot of success with rental properties, both residential and commercial. So I think there's a lot of benefits to that too. You get tax benefits. You get to depreciate the asset class. You get to increase in rent rates to keep up with inflation. So it's a nice hedge against inflation. It's a wonderfully non-correlated asset class. So we love real estate around here. Mm-hmm. I think the key is making a good purchase. And like we talked about earlier with the stock market, you don't want to overpay. So, the three most important things: location, 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 but also what do you pay for it?
And also with a major purchase like that, I would recommend let's set up a time to review your financial plan to make sure that it makes sense, and also to see how it affects the overall plan in general.
Yeah, don't go run. Hey, Brad said real estate's good. I'm in.
No, he said go. Let's pause real quick.
Call us. Let us stress test this in your plan for sure. But no, overall, we like real estate around here. If it makes sense, if you get a good buy, and if it does make sense in your overall financial plan. So,
and then I know I said this already, but it looks like this is the last one. And do you know the answer? Was Allison's Health and Wellness series, was it recorded for future viewing?
I don't think it was. Don't think it was, but she's available if anybody wants a one-on-one consultation with Allison. Happy to introduce you to her, make the connection. And we're looking at having another health and wellness event later this year. So stay tuned for that. Hey, question for the audience, if you wouldn't mind just sending me an email. Do we have an appetite? In the fall, we like to do educational events. A couple of years ago, we did one on Medicare. Before that, we've done a few on Social Security. My question is there an appetite for either a Social Security educational event or a Medicare event? If you wouldn't mind just sending Matt or I an email, letting us know, because we've got some great speakers or we have content as well. The other one we thought would be interesting was a health and wellness event about a high quality of life in retirement. And it's not just about the money as we're talking about, but it's also the big picture and health and wellness and social connections and having a meaningful interaction and a purpose. So if anyone's interested in any of those topics, just give us a heads up, because we really believe that this is a big part of our role, is to just keep you informed about a variety of subjects that really lead to creating peace around the issue of money and having a wonderful life. So with that, Matt and I want to say thank you for participating and being on the webinar this afternoon. It's a pleasure to work with you and to serve you. You really are part of our family, and we mean that. And it's just a pleasure to be part of your life and your journey. So.
Yeah, and this is recorded, so if you want us to send you the link, we can do that, and you can share it with your friends and family as well.
Yeah, absolutely. So, all right, everybody, take care. Have a great evening. We'll see you soon.
All right, we'll see you.
Bye-bye.
Bye.